So last class, we talked about, I guess, in some sense, the theory of monetary policy, by which I mean, um, well, we've had this whole picture of the, demand and supply framework. That's a very, very fast sketch. And we were practicing different ways in which these curves might move and the impacts that it might have if the movements are persistent. And we also talked about what might the Fed do in different scenarios. Let's say if there's a negative demand shock over here, then the Fed might want to lower rates to try and push the demand curve back. We also discussed how with supply shocks things are complicated because since the Fed can't move the supply curve, all it can do is either adjust the demand curve in this way, which makes the inflation worse and probably raises expected inflation, or they could push it this way to try and fight the inflation, but then they're making the recession worse. Okay? So all of that is theory in the sense that it's all framed in the context of this framework. What I want to do today, though, is to think about not the theory of monetary policy, but the practice of monetary policy. There'll be some theory as well, but the emphasis here is going to be on how it is, or what kinds of things does the Fed need to worry about in reality when trying to decide what to do with monetary policy. So to do that, sorry, my eyes are deteriorating. To do that, I want to start with a little bit of history about how it is that people used to think about monetary policy. And as we do that, we'll learn about various problems that have been encountered over the years by central banks around the world and across history. So if you go back long enough, the way a lot of economists thought about monetary policy was in terms of something that you may have heard of. I don't think we discussed it yet, called the Phillips Curve. Have you heard of the Phillips Curve? You may have come across this in other macro classes, or you may have read about it in other contexts. So, from intermediate macro, yes. So, the Phillips curve, the origin of the Phillips curve is the following. There are two things, well, maybe three things, depending on how you count, that someone who's running monetary policy might care about. Now, one of them is inflation, right? The Fed wants to have low, stable inflation. But another thing that the Fed might want is to, I guess it's two slightly different ways of looking at it. One is to make sure that the economy doesn't grow too slowly. In other words, they fight recessions. Another, which I guess is kind of the same thing, is that they don't want there to be too many people out of work. So thinking about it that way, there are two things that the Fed might care about. One is inflation, and the other is unemployment. So what's the Phillips curve? This Professor Phillips, who's a New Zealander, decided, well, why don't we just look at the data for inflation and unemployment? This is a long time ago. So then he might say, okay, let's say 1950, the unemployment rate was 3% and inflation rate was 9. So let's plot 1950. And then 1951, there was a 5% inflation rate and a 4%, sorry, and a 4% unemployment rate. So we plot it there. And then 1952 is somewhere over here. So you see, we're just plotting the value of unemployment for that year against the value for inflation for that year. And you keep doing it year after year after year. And what Professor Phillips discovered was that if you did that, you seem to get basically a downward sloping line. In other words, for the years for which he had data, it appeared that there weren't random combinations of inflation and unemployment. Rather, whenever inflation was high, unemployment was low. Whenever inflation was low, unemployment was high. And so this statistical relationship is the Phillips curve. And at the time, and actually there's some people who still think of it this way, it was interpreted as kind of like a law of nature. That there was a trade-off between inflation and unemployment. Central banks don't like either of these things, but what they interpreted, what the Phillips curve seemed to suggest, right, was if you really hate unemployment, you can get unemployment as low as you like, but if you do that, it'll be at the cost of high inflation. Or alternatively, if you really hate inflation, you think that's the priority, you could get it low, but the cost of doing that would be high unemployment. So this was viewed as sort of a menu of policy choices. Right? The Fed can choose where on this curve it wants to be, adjust its monetary policy accordingly, and end up wherever on its chosen combination of unemployment and insurance. Sorry, unemployment and inflation. Okay. Now let's go back to our theory from Monday or last week that tells us what? Inflation, real GDP. What does our theory tell us? Or to be precise, to ask a more precise question, how could it be, according to this theory, that you might see this set of combinations? High inflation with low unemployment, low inflation with high unemployment. What must be moving in order to generate this picture? Let me see. This is expected inflation. Marshall says from real GDP is correlated with unemployment, right? And that means that the economy must be growing fast when inflation is high and slow when inflation is low, which means that, as Sophia is correctly pointing out in the chat, you would get that if you have a demand curve moving around, right? If it moves this way, what do you get? High growth, low unemployment, high inflation, somewhere over here. The demand curve moves over here, you get the opposite, right? You have slow growth, low inflation, high unemployment, a point over here. So that's how our theory would interpret what Mr. Phillips found. But again, that's only what you get when the aggregate demand curve is randomly moving around. What if instead someone looks at the Phillips curve, let's say it's the Fed, and they say, you know, inflation sucks, but unemployment is worse. So let's inflate so that we'll choose a point such as this. Yeah, we'll suffer from high inflation, but at least we'll get low unemployment. What would happen then? That's different, right? That's not the demand curve moving around randomly. That's the Fed explicitly saying, you know what, we're going to do this. And that's different. Because, and here is where, so there were many economists at that time who would say, actually, guys, if you're going to choose a monetary policy that's inflationary to try and reduce unemployment, that's different from just the demand curve randomly moving. Why is it different? It's different because of a concept that was introduced around that time, so I guess mainly in the 70s. It's called rational expectations. And the idea of rational expectations is that this expected inflation rate didn't just come out of nowhere. This expected inflation rate reflects rational expectations. It reflects people trying to make their best forecast of inflation. And when you and I are trying to forecast inflation, we're rational. That means we're using all the available information to make that forecast. That includes information about the past, right? Like what we've seen the Fed doing, what we've seen in inflation. But it also reflects information about the future. And if the Fed says we are going to target high inflation and low unemployment, that's valuable information about the future. If you know the Fed is going to do this, why would your expected inflation stay the same? It should increase because you know the inflation's coming. And of course, what happens then? What if the Fed announces we are going to inflate, of course, with the objective of lowering unemployment, and we understand that, and we expect the inflation? That means the supply curve will shift also because expected inflation would rise. And would we end up at this point? We would not. We would get a high inflation, but we would not get anything special in terms of unemployment. So it'd be somewhere over here. So this Phillips curve, the observed Phillips curve, isn't a fixed law of nature. It may move. It may move with what? With expected inflation. Expected inflation shifts, the whole relationship changes. This is an example of something that came up again in the 70s that's referred to as the Lucas critique. So Lucas is one of the economists, Robert Lucas was one of the economists who was important in exploring the idea of rational expectations. And the bottom line of the Lucas critique is that it's one thing if your demand curve is jumping around randomly, but it's a completely different thing if the Fed is announcing what its policy is going to be. In one case, if policy is, let's say, a surprise, then it's not expected and it's not factoring into expected inflation, so it'll have a certain impact. On the other hand, if the policy is announced and expected, like in this case that we were discussing just now, then the expected policy may have a completely different effect, right? So, for example, if the Fed had inflated by surprise, we might have ended up here. But if the Fed announces its intention to inflate, you end up here. That's the idea of the Lucas critique. So, I guess a few words about Robert Lucas. He's for this work, he won the Nobel Memorial Prize in Economics in 1995. So that's a statement of how important this theory of rational expectations and the Lucas critique are viewed by the profession. Funny story. Robert Lucas split from his wife some years before that, and as part of their divorce settlement, she insisted that there be a clause that said that if he won the Nobel Prize, she would get half the money, as long as he won the Nobel Prize before 1996, and he won the Nobel Prize in 1995. So, if anyone, his ex-wife seemed to have pretty good rational expectations. I guess she learned something from him. I met Robert Lucas once. I was just hired by GW, and I'd been told that people giggle around him because he always wore a blue shirt and white pants everywhere he went. And so I was at a conference, and I was with Professor Labadie, who just hired me to GW, and she was talking to someone, and I came up and said, "Hello, thank you for hiring me." And I said, "Excuse me, sir, I didn't catch your name." And Professor Labadie looked at me incredulously and said, "This is Bob Lucas." Right? It's a bit embarrassing. The guy is a huge economist. I should have known it was him. But the problem was, as soon as I was told that that was Bob Lucas, I immediately realized that I should have known, because he was wearing a blue shirt and white pants, which made it hard for me not to giggle. But anyway, enough about Bob Lucas. So, what have we discussed so far? First, there was this idea of the Phillips curve that was viewed as being a menu of policy options, basically. But then along came rational expectations and the Lucas critique. Rational expectations tells us that people are forming their expected inflation based on all information, including past and future. And future information includes specifically what you expect the Fed to do. And that's where the Lucas critique comes in, which is basically arguing that the effect of a policy is going to be completely different depending on whether or not it was expected. Okay? Any questions, comments about that? So let's take that idea and run with it. So the key factor behind the formation of our inflationary expectations is what we think the Fed will do. And let's see what we can derive from that. If the impact of policy depends on what we expect the Fed to do, that essentially means that the Fed is constrained in what it can do. It always has to figure out what impact what it does might have on expectations. So we've had rational expectations and connected that to the Lucas critique. That also connects to a third concept. All of this is bundled together in the same chapter. I think it's chapter 23, which is the notion of what's called time inconsistency. Can't spell today. Which means, I guess one way of thinking about it is the Fed can't fool you, right? So we just explained that the Fed would maybe like to give us some surprise inflation to try and boost growth sometimes. If we know that, well, the Fed can't do it because it's because we know that they might say to us, expect low inflation, and then try and give us a little surprise inflation later on. Well, we would know that because we know what the Fed's incentives are, and we wouldn't believe their announcement that they're going to seek low inflation in the first place. Let me give you a better example, actually. So we know that the Fed doesn't like inflation. We also know they don't like unemployment. So imagine that the Fed announces a policy to try and get inflation down. Now, the key lesson from the Lucas critique and from rational expectations is that the impact of this announcement is going to depend on whether or not we believe them. The term that the textbook uses for this idea is that it depends on whether or not the Fed's announcements are credible. Now, what might there be that makes the Fed credible or not credible? Here's an example of something that would make the Fed's announcements that they're going to keep inflation low not credible. For example, what if we knew that the Fed chair is a friend of the president? Why might that matter? Well, it matters because what do we know about politicians? Let me see. Someone wrote something in the chat. Right. Politicians tend to get re-elected when jobs are growing and the economy is doing reasonably well. And so, as Marshall says, if you're a politician, you probably would rather emphasize unemployment rather than inflation, especially close to elections. So the Fed might be under pressure not to go through with this policy of lower inflation, especially when elections are coming up. And especially if the Fed chair is an ally of the president. And in that case, we, the people, would not believe this announcement. This announcement would be what's called time inconsistent, because you may say that you don't like inflation, you may say you want to lower inflation, you may even believe that that's truly what you want deep down. But we also know that when push comes to shove later on, when the election is coming up, Fed will not go through with that announcement because of, in this example, political pressure. And this is the kind of thing that you and I would have in mind in our rational expectations, and that constrains what the Fed can and can't do, because some things it might want to do, like supporting low inflation, might not be credible to the extent that they're under political pressure. And you might wonder, is this story of the Fed chair being pressured by the president for electoral purposes far-fetched? I would say no. I think it's widely believed that one of the reasons in the 70s when there was increasingly high inflation, one of the reasons why the inflation got out of control is because the chairman of the Fed was a buddy of Nixon, who was running for re-election. And so when the stagflation came along, because of politics, they were more likely to fight the recession than to fight the inflation. And as discussed last week, if you fight the recession, you're increasing expected inflation. Marshall asks whether the president appoints the Fed chair, and the answer is sort of. So the Fed chairs serve 7 years. That means that that presidents often have the Fed chair that was nominated by a different president. So Jerome Powell right now, for example, is a Trump appointee, but he's still there. If you were following the economic news a few years ago, you may remember that in the run-up to the election, even in 2019, the Fed chair was under a lot of pressure to lower interest rates, even making them negative. By pressure, I mean there were a lot of tweets from the president at the time along the line saying the Fed should be brave and should have negative interest rates and so on. Some would have interpreted that as being also political pressure to try and boost the economy before an election. The Fed didn't adopt negative interest rates, so they didn't give in to that pressure. But in any case, what it does mean is that that pressure is real. It's not hypothetical. So given that there may be political or other reasons why the Fed can't commit to delivering low inflation, this started up a whole debate about whether, instead of the Fed using discretion, by which I mean they observe things as they happen and decide how to respond with monetary policy depending on what's going on, whether instead of that, central banks should instead adopt some sort of explicit rule to try and tie their hands and thus potentially increase their credibility. So we've gone from rational expectations means that the Fed is somewhat limited in what it can do because people's expectations are people's expectations affect the outcome of policy. And since there may be political constraints on what the Fed does, that means that it cannot credibly commit to certain things that we might like, such as having reasonably low inflation. And as a result, some economists think that maybe it's possible that instead of having discretion in monetary policy, that the Fed should instead adopt some kind of explicit rule to try and maybe get better results. So to talk about these policy rules, I think we need some examples. So let's look at an example of a policy rule. Now, I guess the hardest, most rigid policy rule that I can think of in history was something that the Swiss central bank did a long time ago. So the Swiss central bank many years ago adopted what was called a monetary base growth rule. So I'm just going to write that down, then explain where they come up with that. So imagine the rule was something like the monetary base is going to grow every year by exactly 5%, let's say. And then no matter what happens, they just make sure that the growth in the monetary base is this stable annual 5% rate. Okay. Why would they do that? Well, I guess the Swiss central bankers at the time must have been from a group of economists known as monetarists. And monetarists have the view that fluctuations in the aggregate demand are ultimately due to fluctuations in the money supply. That's why they're called monetarists. And so if you're a monetarist, how will you deliver stable, low inflation? Just make sure that your money supply grows at a stable rate. And that's the aim of this monetary base rule, right? The idea is if you grow the monetary base at a stable rate, then your money supply will grow at a stable rate. And since you're a monetarist, you think the aggregate demand curve will be thus stable. So this idea is, focused on stable and low inflation. Seems like a good idea, especially if you're a monetarist. Didn't work though. What could have possibly gone wrong, do you think, with this plan? And I guess one answer might be monetarists could be wrong about how the supply curve, how the aggregate demand curve is linked directly to the money supply. But even if you are a monetarist, what could go wrong with this? Well, the monetary base is not the money supply. The money supply is the monetary base times the multiplier. So what could go wrong here? Even if you're a monetarist, multiplier could change. So what happened is at some point, one of the government in Switzerland changed some rules. I don't remember exactly what they were, but they changed the rules in a way that meant that banks suddenly didn't feel that they needed to hold as many reserves. So what happens is all the banks lower their reserve ratios and start lending more. The multiplier goes up, money supply goes up, and they got a burst of inflation, which is exactly the opposite of what the whole point of this rule was. So I guess what this suggests is that there may be downsides to rules as well, because it may be hard to adapt a rule to a new situation. In this case, when the multiplier rose, maybe they should have slowed the monetary base growth rate to try and keep the money supply stable. But that suggests, well, maybe we should just have rules that are a little more flexible, right? That's what some economists think. So let me give you an example of a slightly more flexible rule. I'm going to tell you about something that some economists think might be a good idea. It's called the Taylor rule, named after John Taylor, a Stanford economist. Now, the Swiss rule we had here is focused on low inflation, right, and trying to keep inflation stable. And they were trying to do it by having this very rigid rule. But now let's try and codify a slightly less rigid rule that tells us what we want to do if we want to try and keep inflation low and stable. Everything we talked about on Monday would suggest that if you want to keep inflation low and stable, you should raise rates when inflation rises and lower rates when inflation drops, right? So that's trying to get your stable low inflation, but sort of a less rigid way. And then you don't do anything with rates if inflation is at some low stable level. But the Taylor rule, as I said, is a bit more flexible. And in addition to having this prescription of raising rates to fight inflation, it has a second part. It also says you should raise rates when growth is too fast. In other words, it doesn't just focus on inflation, it also has stipulations about how to respond to the business cycle. So here is why some economists like the Taylor rule. So here is our macroeconomy. Let's see. Suppose something happens that means that the demand curve moves over here, and so inflation is too high, and we're also growing, let's say, a little too fast, so to speak, right? If we stay there for too long, expected inflation may rise, so we don't want that. What does the Taylor rule say we should do? Well, inflation is high, so we should raise rates. That's what the first part is telling us. And the second one says growth is too fast, so we should also raise rates. Okay? So unambiguously, it's telling us raise rates. What if the demand curve is over here? Well, we have a recession. Inflation is lower than expected, so this is telling us to lower rates. And growth is slow, so this is also telling us to lower rates. So we lower rates. Okay? So it's not, so far it isn't clear what we gain by having both of these parts to our Taylor rule. Now suppose instead we have a supply shock. This is what Taylor rules, this is part of what the Taylor rule is for. Well, we have inflation that's higher than normal, so we should raise rates, according to this part of the Taylor rule. But on the other hand, we have growth that's slower than usual, so this part says we should lower rates. So what should we actually do? Well, one part says raise rates, the other part says lower rates. So what do? Not much. The rule says that these two considerations would cancel each other out. And what is the point of that? Well, remember, if we had focused on just this part, if we raise the rates, what happens? Well, you make the recession worse. On the other hand, what about this part? If you lower rates when you're in stagflation, what do? You raise expected inflation, make the problem even worse for later. So what's the idea of the Taylor rule? It's there to fight recessions when there are demand shocks. But when there's a supply shock, what it tells you is sit tight, don't do anything because you don't want to mess up expected inflation. Okay, so that's how it's a bit different from discretion. The point being that when a supply shock comes along, if you're constrained to following a Taylor rule, you're not going to make matters worse. You're not going to do something rash that may increase expected inflation and keep the stagflation going on for even longer. So that's the idea of the Taylor rule. Any questions, comments? The Taylor rule focuses both on inflation and on output gaps. In the case of demand shocks, both prescriptions tell you to do the same thing. In the case of supply shocks, they cancel each other out, and the idea is, again, at least not to make matters worse. Now, since discretion has one problem, which is timing consistency, but on the other hand, rules have kind of a problem. They could be too rigid. What that means is that there's maybe a third way to try to balance the upsides of rules versus some possibility of discretion. But that's what we can refer to as constrained discretion. So what do we want here? Well, remember that the key points of rules, of policy rules, was to try and make things predictable and to also try and stabilize a low level of expected inflation. So the question is there some way of doing that without following a rigid rule like Switzerland, or the Taylor rule for that matter? If the goal is to stabilize expectations, maybe there's some way of doing that without having a rule. Instead, what you need to do is to have something that people understand that helps to achieve this goal. So the way the textbook refers to is that it says that the Fed has to select something it calls a nominal anchor. Broadly speaking, a nominal anchor means something to do with prices. That's what nominal means. That helps to keep them visible and stable for all of us. And so broadly, it's some tool to try to keep expected inflation stable. So that may sound a bit vague, something to do with prices that we use to try and keep expected inflation stable. I think it'll become more clear what I mean when I give you an example. Actually, I can think of 3 examples. One example, probably the main example, is what the United States actually does. The United States pursues a form of constrained discretion that's known as inflation targeting. And inflation targeting has 2 parts, and this is key to the functioning of the nominal anchor. The first part is that you announce that your monetary policy is going to try and hit a particular inflation target. Let's say 2%, which is actually their inflation target. So that's part 1. Part 2, you do everything you can to try and hit the inflation target. It doesn't say what you're going to do, right? So it doesn't say my monetary base is going to grow by exactly 5%. And it doesn't say I'm going to adjust interest rates according to a Taylor rule formula, depending on inflation rates and growth. It just says I'm going to do whatever it takes to get this 2% inflation. In that sense, it's not really a rule. Constrain your discretion because in order to maintain credibility, you're going to have to do what you can to try and hit this target. But if you achieve that, what have you also managed to do? You've achieved the goal of making sure that everyone expects stable 2% inflation. In other words, this is a way of trying to get around this timing consistency problem. You announce this target, you've kind of constrained yourself in advance, because if you don't hit the target, then you're going to cause problems one way or the other. And then you just do your best to try and hit it. So that is actually what the Fed does. It has a 2% inflation target. And what does that mean? It means that whenever there are demand shocks, what's the Fed going to do? It's going to try and get you back to the level of expected inflation, which is 2%, and everyone knows it's 2% because it's pre-announced target. And of course, if the Fed has a track record of actually hitting its target. In the case of supply shocks, what does inflation targeting mean? In the case of supply shocks, it means, I guess, the Fed would rather make the recession a bit worse just to make sure that it maintains its credibility as an inflation fighter. So that's one rule. Sorry, that's one example of constrained discretion. The text mentions another form of constrained discretion, which is called nominal GDP targeting. Now, aside from what might or might not be the benefits of this, I guess the idea is if GDP is growing at if nominal GDP is growing at a constant rate, well, that mixes inflation and growth, right? So I guess that means when real GDP is growing fast, you want to lower inflation, which means you raise rates. When real GDP is growing slowly, you want to raise inflation, so you lower rates. So I guess it has some flavor of the Fed acting to try and stabilize things, but I wouldn't advocate it myself because a key idea of constrained discretion working is that the people have to understand what the Fed is trying to do so that they can form stable expected inflation. And what better way to do that than by actually telling people what inflation they should expect? You tell people to expect a certain growth rate of nominal GDP, most people won't know what you're talking about, right? Not everyone knows what nominal GDP is, nor would they necessarily understand how and why this is supposed to work. So I wouldn't advocate that, but it is something some economists advocate. There is actually one more nominal anchor that we've discussed. Remember a long time ago when we were talking about currencies, we talked about the possibility of having a fixed exchange rate. And I said at some point, well, the reason you might have done that is because you'd been very bad with inflation in recent years. And so fixing your exchange rate is a way of the Fed, of the Bank, to try and regain credibility. Because if you're fixing your exchange rate, you can't just inflate whenever you feel like it, whether it's to win elections or anything else. So that, the fixed exchange rates, is also an example of a central bank adopting a nominal anchor to try and stabilize inflation and gain credibility. So we actually visited this issue, touched upon this issue a long time ago, though we didn't really have the language of time consistency and so on to talk about it. Any questions, comments about any of this? So to summarize, the idea was that in practice, monetary policy is constrained by the fact that the outcome of monetary policy depends on our expectations. We're not fools, so we know that if central banks had full discretion, they might be tempted to inflate because of political pressure or maybe other reasons. And so that makes the goal of having low expected inflation difficult. One solution was to have these key rules, the Taylor rule, monetary growth rule, and so on. But a downside is that, well, they're rules. They're not flexible. So if new things come up, they may not be particularly well suited for the new environment. And so an alternative solution is this constrained discretion where, again, you have some nominal anchor, which is something to do with prices that you're targeting. Like in the case of the United States, it has a 2% inflation target. And as long as it regularly delivers on that target, then it's achieved the goal of having low stable inflation. Could the Fed lose this credibility? Absolutely. How would they lose it? Well, just fail to hit your target for a period of time. And there is some fear that that could happen. As we were discussing last class, expected inflation has been rising in the United States. And if it turns out that the Fed does indeed, well, there's discussions that because of all the monetary and fiscal stimulus, and also because of some supply chain shortages, we may have a burst of inflation at some point, maybe over summer. If it's just a short, the Fed has said there may be a short burst in inflation over summer. We're going to ignore it. Once that little burst of inflation is over, we'll just go back to our usual 2% inflation target. But the fear is, again, if it starts to feed into expected inflation, then it's no longer just a little quick burst of inflation. Then it could be persistent. So, well, we'll find out if the Fed is able to maintain its credibility very soon. Any further questions, comments? Three, two, one. Phillips curve is a statistical link between what? Inflation and growth, unemployment and growth, inflation and unemployment, or interest rates and unemployment? It is inflation and unemployment. Good job. Good job, Ezra. At first, the Phillips curve was viewed as what? A menu of policy options, evidence that monetary policy is difficult, a menu of policy options. Very good, everyone. Good job, Sophia. Question 3. Rational expectations argues that people's forecasts are based on what? Rigid rules, only past experience, only Fed policy declarations, or information about the past and future. Very good. That's right. We're also figuring out what the future might hold. Question 4. Robert Lucas likes blue shirts and white pants. True or false? That's right. He does. If you ever see him, check it out. True or false? Robert Lucas won the Economics Nobel Memorial Prize. He did. That's right, in 1995. Good job, Ezra. True or false? Robert Lucas got to keep all of his Nobel Prize money. Nope, his wife took half of it. Very good. Or ex-wife, I dare say. The Lucas critique says that the impact of a policy depends on what? Its size, its nature, whether it was expected, or whether it was inflationary. What is the Lucas critique? Whether it was expected or not. That's right. Question 8. The Lucas critique says that the impact of a policy depends on its size, its nature, whether it was expected, or whether it was inflationary. All right, guess you didn't expect that. Guess what the next question is? The Lucas critique says that the impact of a policy depends on its size, its nature, whether it was expected, or whether it was inflationary. You should have grown to expect that by that point. All right. What does the Lucas critique say about the Phillips curve? And here's a photo of Phillips, Alban Phillips. That's right, it may change with expected inflation. Very good. 11. A professor announces there will be no great inflation, but he likes his students so much he gives them all A's. Is this constrained discretion, rational expectations, the Lucas critique, or time inconsistency? It is time inconsistency. 12. To the extent that politicians can pressure the Fed, what would you expect to happen before an election? Faster growth, slower growth, higher interest rates, or slower inflation? Faster growth, that's right. They may boost the economy for the election purposes. The Swiss central bank announces the monetary base will increase by 5% each year. What could possibly go wrong? Even if you're a monetarist. The multiplier might change. That's right. Which is what happened. What is the policy rule that watches both inflation and output gaps? It's named after this gentleman. This gentleman is John Taylor. It's the Taylor rule. Next, a nominal anchor is what? A pet you name Angkor, the capital of the Khmer Empire, the tool to stabilize expectations, or a high level of inflation? Excellent. A tool to stabilize expectations. Very good. What does the Fed say its nominal anchor is? It is an inflation target indeed. Almost there. What is the Fed's official inflation target? Zero, 2, 5, or 100? It is 2%. Very good. 18. What is an advantage of rules over discretion? So what's good about rules in monetary policy? It's stable expectations. Very good. Last question. What is an advantage of discretion over rules? Is it because the Fed is run by wise elders? Rules may not work in new situations. That's right. All right. Let's see how we did. Alexandra V is in third. Nice work. Sophia is in second place. Excellent. And first place, it is Marshall. All right. Okay. So, what shall we do with Snapchat today, Marshall?
I'll let other people take it.
All right. Sophia was second. Any ideas?
Maybe do a cat filter.
Cat. Let's see. What cats do I have? I have a cat on my head. Does that work?
Yeah, that works. Thank you.
I also have this one, which is a bit different. All right. Thanks, everyone. I hope that was useful. Take care. Feel free to write if you wish. If not, I'll see you in class next week. Take care. Thank you.